no one's asking me outside, wow, this market's hot. I mean, it's hot outside, but no one's I don't see the froth necessarily, although most professionals seem to think that we're very frothy, or at least the fundamentals do not justify the levels in the stock market.
Yeah, I mean, I think maybe Sarat could talk to this. The people who build an earnings model and look for a catalyst and say this is why this stock should start accelerating higher here, maybe don't see as much just because the earnings are kind of flattened out in general across the market. But I agree with you. The market definitely, kind of broke out to a new high. It's been a very mild pause or pullback, whatever you want to call it. The problem, I think, psychologically is that we've had a couple of these breakouts in the last year and a half that didn't really last very long, and they unwound. I don't think you're seeing signs that that's going to happen this time necessarily. So yes, a pause is the way I would describe it, at least for now.
Someone's going to be right, someone's going to be wrong. I mean, we're going to report on Morgan Stanley results. They're doubling down on. We went above 3,000 on the S&P. They're doubling down on. I mean, they have a number as low as 2,400 on the S&P as a possibility. I think 2,750 though was a year-end type target.
Yeah.
So when do the dead enders throw in the towel?
I don't know if that's what we're necessarily going to see. I mean, they're talking about a range of 2,400 to 3,000.
I know, because you're thinking 3,000 is the upper end of the range, too.
No, not necessarily. No, I don't necessarily.
Well, if you did think that, you wouldn't call them dead enders. But if you think we're going to 3,400, they're dead enders.
Right. Well, I mean, then they would chase the market up, is what.
Yeah, but when do they change? When do they say, I'm at 2,750? And then they change it and on a Friday afternoon at about 5 o'clock, and then next time they're on, their target's 3,100.
They'll change it when we get the inevitable pullback, right? Which is what I believe is a short-term pullback. I'm more in the camp that I think things are going to be better for longer. It's a slower growth that we have for the next few years, but it's still going to be growth. And I think
that supports stock prices, sir?
That absolutely supports stock prices, especially in the U.S. and especially when you look at where interest rates are. So I think, we're back to this whole argument about what do you do with your capital. Rates at 2% are very hard for long-term investors to invest in. And if you look at kind of where you want to put your money, I think of it as a barbell approach. You look at growth stocks that have secular growth stories in them, companies like an Interactive or Constellation, or you look at dividend stocks that have good fundamentals, like a Blackstone.
I see that you are sort of just reading your comments. You're picking some stocks based on not quite being that excited about a macro move in the market. So you're looking for secular growth, and you're choosing your spots rather than just saying we're headed higher.
Right, because I think in December we were heading higher when we had the 20% pullback. I think there are parts of the market that are pretty fairly valued, especially when you look at
I think a lot of people do, yeah.
But there are parts of the market that I think if you're a stock picker and you're looking at 3 to 5 years out, there are opportunities, and it's not a time to run away, as a lot of people think, because when you get back, and I think there are some really good companies out there that you can buy today that have good stories.
How do we know it's not a total bubble based on a credit market bubble or a bond market bubble that just is feeding into stocks? That's what everyone says. It's the Fed. It's all the Fed.
So part of it is also the Fed, but part of it is also the credit market. I mean, the credit market will start telling you when spreads widen, when companies can't get access to capital either. We haven't really seen that yet. Yes, on the high yield market and the energy market, you've seen that. But on other companies, spreads have tightened over the last 6 weeks, and you're seeing real yields come down. So I think the opportunity there, at least the credit markets are telling you that there is some opportunity in the equities, but credit as a whole, just because globally rates have come down.
I look at your notes, right? You got both cheeks covered on all these things.
These cheeks?
No, I didn't mean those. What's the bond market worried about? Deflation and a global slowdown. Right. I mean, so
he's just assessing.
I know, but
part of the same thing.
I know, but I want to know which is more important. Are we slowing down, or is it okay to do this because there's no inflation?
We are definitely slowing down globally.
What about here?
Here we are slowing down, but we're still growing. We're growing 1% to 2%, and the rest of the world really doesn't have that. And if you got companies that can grow faster than that, that's where the opportunity is, not the companies that are going to be either that growth or slower.
You have a moment here where a soft landing and a pause in growth looks a whole lot like pre-recessionary, we're in trouble. Can we keep this from getting out of control? That's why the market trades where I'm very persuaded by the idea that bond yields are going to have a bias lower when the data soften up, because at some point in the market's mind is we're headed back to zero in the next recession.